Taking my most recent video one step further, let's take a look at the popular Dow to gold ratio. For those unfamiliar with the Dow to gold ratio, some in the precious metals camp claim that the ratio of the Dow Jones Industrial Average to the price of gold per ounce, based upon the observation that it has fallen to the level in the 1 to 2 range on a couple of occasions in the past, will do so again. By this reasoning, it is inferred that when this ratio falls in the 1 to 2 range, it is a signal to start selling gold and buying stocks. The appeal of this argument is that it provides some level of guidance as to the relative desirability of equity versus gold. One can generally take a look at measures of equity valuation such as price-to-earnings ratios, price-to-sales, dividend yields, Tobin's Q, and so on, to determine if equities offer a reasonable rate of return. But the trouble is, these measures omit the value being placed on real money, gold. Yes, even sound money such as gold varies in value over time as society changes its preferences for saving over consumption. And this is true now, just as it was true during the gold exchange standard and the gold standard. As a side note, this is one of the reasons why pyramiding credit atop a gold money base led to so many problems in the past. As society shifted its preferences to savings over consumption, the value of the gold money would rise and the debt would become unpayable, regardless of what the government said its value should be. Chew on that for a little while. But back to the Dow to gold ratio. The weakness of the Dow to gold ratio, in my eyes, is that although it has seen several cycles, it shows peaks and troughs at different levels. In 1929, it peaked at 15.3. In 1966, it peaked at 28. In 2001, it peaked at 41. Some of this could be due to American businesses simply growing in overall value faster than the appreciation rate of gold. If this is the case, then what is one to estimate for the next level at which the ratio will peak? Similarly, the trough in 1933 was 2.3, while the trough in 1980 was 1.1. And if the reason why the peaks increased was the growing value of American businesses, then why would the 1980 trough be lower than the 1933 trough? I think the answer has something to do with American business value going up, but also has something to do with our monetary system becoming more unstable over time. In any event, the fact that we don't have a well-defined point at which the ratio has turned around somewhat limits the usefulness of this tool as a valuation metric. What will constitute a good signal for selling some gold and buying equities? Should we wait for the Dow to gold ratio to hit 2? Should we wait until it hits 1? Will it ever get there? It reminds me a little bit of the conundrum of determining when to sell silver to buy gold. Sure, one can wait until the gold to silver ratio reaches 16, simply because it has been at that level sometime in the past. But if it never goes back to that level, then the valuation target is hardly useful. As it is with gold versus silver, so it is with gold versus stocks. But just because the absolute turning points from the past may not be useful from the standpoint of absolute levels, doesn't mean that they can't be useful from the standpoint of predicting the timing of a turning point. Let me elaborate. If we look closely at the data, just as we saw with the gold price relative to its long-term trend, we'll see that the deviation of the log of the Dow-gold ratio around its long-term average of 0.9 is fairly periodic. The magnitude of oscillations appears to have grown, but the distance between the peaks is fairly similar. There were 37 years in between the peak of 1966 and 1929, and there were 35 years between the 2001 peak and the 1966 peak. There was a greater amount of time in between the 1933 trough and the 1980 trough, which implies that if we look at all of the data points together, and not just the peaks, we will find that the cycle time of the Dow to gold ratio is somewhat greater than 37 years, and we'll do this in a minute. The key insight, at least to me, that we can obtain from the Dow to gold ratio is that waves of optimism and pessimism tend to follow long-term cycles, and many economists have drawn this conclusion. When optimism is at a peak, the Dow to gold ratio will also be at a peak. When pessimism is dominant, then the Dow to gold ratio will be at a trough. The absolute level at which the ratio turns will be hard to predict, but the timing might be a little easier to estimate ahead of time. So let's do a bit more rigorous mathematical analysis to learn more about the properties of this cycle, just as I did in my most recent video. Let's take a look at the autocorrelation signature. And here it is. Just as we saw with the gold cycle, the autocorrelation of the Dow to gold ratio declines slowly as the time lag increases. Where this autocorrelation signal becomes very interesting is that there is a fairly strong negative autocorrelation at 21 years, which then turns up and becomes a positive autocorrelation, which peaks again at about 42 years. And what this means in layman's terms is that the Dow to gold ratio is periodic, with the period of a full cycle at 42 years and half a cycle at 21 years. Thus, we can expect peaks in optimism to be spaced about 42 years apart, and peaks in pessimism to be also spaced about 42 years apart. And transitions from maximum optimism to maximum pessimism should be about 21 years apart. The negative autocorrelation of minus 0.5 at 21 years can be explained as follows. There are many factors, both measurable and unmeasurable, that will dictate the Dow to gold ratio at any point in time. Among these factors, about 50% of the variability in the Dow to gold ratio is explained by the level of the Dow to gold ratio 21 years in the past. And this is useful. We can be reasonably confident that if the Dow to gold ratio is unusually high now, then in 21 years it will be unusually low, and vice versa. And let's see why this might be important to us at the present time. Going back to our Dow to gold ratio chart, if we assume the next trough will be 21 years from the previous peak, or a half cycle, then that takes us to the year 2022. If we further assume that the next trough will be 42 years from the previous trough, then it takes us again to the year 2022. Coincidentally, the year 2022 is 1 year after the year I predicted in my previous video. That could very well be a coincidence. I don't know. One can be naturally skeptical that we'll see a large change in the Dow to gold ratio over the next 4 years. After all, the ratio has climbed from 7.2 in 2012 all the way to its current level of 19.6. Certainly it seems to be going the wrong direction if in fact the mood of the world is turning to pessimism. But one should consider why we've seen this rebound. The central banks of the world have pulled out all the stops when it comes to pushing down interest rates on short and long end of the curve. Some are even buying stocks. Corporations, who have access to very cheap money, are also buying back their own shares on borrowed money, primarily to push stock prices up in order to transfer wealth to the executives who have lavish stock option incentive plans. And the rest of the crowd primarily relies upon trend following to do their investment thinking for them, rather than conducting proper fundamental analysis. All of these factors will result in a rapid increase in stock prices. That is, until the music stops and all of the effects go into reverse. And going into reverse, I'm sure they will. And when it happens, the change will be pretty violent. How violent? Well, we can take a look at the violence of corrections in the past. We can see that the correction of the early 30s was pretty steep and fast. Coincidentally, the steepness of that correction was exactly the same as the steepness of the correction in the 70s. The only difference was that in the 70s there was a break in the action. There was a bounce in the Dow to gold ratio that lasted for a couple of years. But one can see the sheer amount of damage that is done quickly during one of these corrections. Let's see what might happen if we have a correction from this level of our present time of similar duration and ferocity. And in doing so, we find that one correction leg of similar duration and magnitude would take us right to the beginning of the year 2022 at a Dow to gold ratio of 4. Am I confident that this is the way that things are going to play out? Not necessarily. Do I see it in the realm of possibilities? Absolutely. But think about the potential implications. A person who holds gold now instead of stocks may find that in 4 years' time, he or she can buy 5 times the amount of stock with their gold. To me, that's a pretty powerful transfer of wealth. It is certainly worth giving some consideration, given the relatively high valuations assigned to stocks and bonds today. I believe that we are in the middle of a financial market mania. The switch back to pessimism is going to be hard on a lot of people, but not hard on the ones that hold true money.